Welcome back to Talk Tickers. This is the place where we strip down the earnings calls, bypass the corporate fluff, and get straight to the signal.
That's the mission.
Today, we are looking at a ticker that has been making some serious noise in the networking world. We are talking about Extreme Networks, ticker symbol EXTR.
It is good to be here. And noise is probably the right word, considering the volume we saw. We're breaking down their Q2 fiscal year 2026 earnings call, which happened back on January 28th.
And if you've been following the hardware space, you know it has been a tough year. A lot of inventory digestion across the board.
Mm-hmm. But they seem to be playing a different game right now.
Yeah, they really are. And right out of the gate, we have to talk about the scoreboard. The market reaction was, well, it was awake.
That's one way to put it.
The stock jumped 6.8% in the pre-market. So it moved from around, $14.70 to nearly $15.70. But for me, the price wasn't even the headline. It was the volume.
The volume was huge.
4.5 million shares traded versus their average of under 2 million. I mean, people were paying attention.
They certainly were. And usually when you see that kind of volume spike alongside a price jump, it tells you something. It indicates institutional interest.
The smart money.
Right.
Yeah.
It tells us the smart money was waiting for validation. There has been this thesis floating around that Extreme is undervalued, relative to its growth, but investors needed proof.
Proof they could navigate these supply chain headwinds.
Exactly. And that volume spike suggests the big funds got the proof they needed. So the vibe on this call, it wasn't just relief, it was constructive. It felt bullish.
It really felt like a classic David versus Goliath story, didn't it?
That's definitely the narrative they're pushing.
You have this smaller player, Extreme, basically looking at the giants like Cisco and the newly merged HPE-Juniper entity and saying, we are eating your lunch.
That is the claim. And they do have some data to back it up. They were not subtle about it. But, big talk is cheap on an earnings call.
Very cheap.
We need to see if the numbers actually back up the bravado. So let's set the table with the headline numbers. What did the scorecard actually look like?
It was a clean beat. Revenue came in at $317.9 million, which beat the consensus of $312.3 million. That's up 13.8% year over year.
And this is their 7th straight quarter of revenue growth.
7th straight.
Yeah. Consistency matters. In a volatile tech environment where a lot of hardware vendors are reporting flat or even declining sales because of customer stockpiling, 7 straight quarters of growth is a serious outlier.
It signals they aren't just riding a cycle.
Right. It suggests they are taking share.
And on the bottom line, non-GAAP EPS was $0.26, which beat the $1.24 consensus. So they sold more and they made more profit on what they sold.
And then they raised guidance. Management pushed their full-year outlook to a range of $1.262 billion to $1.27 billion.
And that guidance raise is so crucial, isn't it? A beat is about what you did yesterday.
A raise is about how confident you are in tomorrow. But I want to point out the quality of these earnings. I mean, it wasn't just accounting tricks. Their SaaS annual recurring revenue, or ARR, hit $227 million.
That's up 25% year over year.
25%.
So let's break that down for the listener who might not be a CFO. Why does shifting from hardware sales to SaaS ARR matter so much for the valuation of a company like Extreme?
Well, think of it like the difference between selling a car and selling a Netflix subscription.
Okay.
When you sell a networking switch, the hardware, you get paid once. That's lumpy revenue. And you have to resell that customer again in 5 years when the box wears out.
Right.
But SaaS ARR is a subscription. It is predictable, it's high margin, and it sticks. Investors pay a much, much higher multiple for software revenue than hardware revenue. Extreme is proving they're successfully morphing from a box shifter into a software company.
And also look at the free cash flow, $43 million this quarter. That's compared to just $16 million a year ago.
So they're actually generating cash, not just paper profits.
Exactly. The bank account is healthy.
So let's get to the deep dive. I really want to unpack the why behind these wins, because management was throwing around some pretty heavy terminology, specifically agentic AI.
Right. This is their Platform One narrative. And usually when I hear AI on an earnings call, I kind of roll my eyes.
Everyone's an AI company now.
Exactly. If you have a spreadsheet these days, you call it AI. But they had a specific example that really stopped me in my tracks. They quoted a Fortune 100 customer who said, and I quote, "What takes Cisco 6 hours takes Extreme 6 minutes."
That is the Cisco killer quote. And it's fascinating because they aren't just talking about a chatbot that writes emails. We need to distinguish between, generative AI, which creates content, and agentic AI.
Okay, so what is the distinction there?
An agent has the authority to act. So in networking, an agentic AI system doesn't just tell you, hey, the Wi-Fi in the warehouse is broken.
It does something about it.
It diagnoses the root cause, reroutes the traffic to bypass the broken switch, and then applies a patch all autonomously.
So it's the difference between a warning light on your dashboard and a self-driving car that just steers you around a pothole.
Precisely. The 6 hours refers to the time a human engineer spends typing command codes into a terminal to hunt down a problem. The 6 minutes is the software doing it all automatically.
6 hours to 6 minutes. That is an eternity in IT time. I mean, if your Wi-Fi is down for 6 hours at a stadium or a hospital, heads are going to roll.
Oh, absolutely.
Yeah.
And the context for that speed is their fabric technology, specifically something they call zero-touch provisioning.
We should probably clarify what fabric means here, because to a layperson that sounds like, I don't know, textiles.
Good point. So in traditional networking, the Goliath way, you have to manually configure every single switch and router, almost like connecting a bunch of individual pipes.
Okay.
If you want to change the flow, you have to touch every single pipe. Extreme's fabric creates a mesh. It's like a single intelligent nervous system. You configure the edge, and the core of the network just figures out the rest automatically.
So the idea is that you plug the hardware in, and the software, the agentic AI, configures it automatically.
Basically. And it creates a segmented network that hides IP addresses, which is also a massive security feature. I mean, hackers can't attack what they can't even see.
Which brings us back to the CEO, Ed Meyercord, explicitly saying they're growing 3 times faster than their largest competitors.
And he named names. He referenced Cisco and the HP-Juniper merger directly. He didn't just say the competition.
No, he did not.
He is capitalizing on the chaos. That HPE and Juniper merger is creating so much uncertainty, customers don't know which product lines will survive.
Like, will the Juniper switch I buy today be supported in 2028?
Nobody knows.
Oh.
So CIOs are freezing orders or they're looking for alternatives. And Extreme is just stepping in and saying, hey, we are stable, our platform is unified, and we are faster.
And they are winning big names. It's not just small offices. We are talking about a massive win replacing Juniper at a large U.S. school district, a multi-million-dollar deal.
They mentioned wins at NFL and MLB stadiums. Retail wins with Kroger and FedEx. Healthcare with Henry Ford Health and Baylor University.
The stadium wins are particularly impressive. I mean, those are high-density environments.
The ultimate stress test.
For sure. If you can make Wi-Fi work when 60,000 people are trying to upload a selfie at the exact same time, you can make it work anywhere.
Absolutely.
Right.
If Extreme can make the network work seamlessly during the Super Bowl, a hospital or a warehouse is a walk in the park.
It really paints a picture of a company that is punching above its weight class. But speaking of that, I have to talk about this supply chain story. This is my favorite part of the call. It felt like an episode of MacGyver.
The DDR4 memory chip situation.
Yes. So apparently there is a global shortage of DDR4 memory chips. The big guys are struggling to get them, but Extreme, they went hunting.
It's a great example of agility. They found this aging inventory of DDR4 chips that were designed for a completely different industry, not networking at all. They grabbed them, went to their chip partner Broadcom, and said, can we make these work? Broadcom certified them, and Extreme just swapped them into production.
That is wild. They basically raided a different industry's leftovers just to keep the factory running.
And management cited this as a specific benefit of being smaller and more focused. You know, if Cisco needs chips, they need millions of them. If Extreme needs them, they need thousands.
So they can be scrappier.
Much scrappier. They can pivot their supply chain in weeks, whereas a massive ocean liner of a company takes quarters to adjust or validate a new component source.
It's the speedboat versus the ocean liner. And in this case, the speedboat found the fuel. Now, I want to play devil's advocate for a minute.
Okay.
They're agile, they're growing, but they also raised prices by about 7% last quarter. Usually in a competitive market, raising prices is a good way to lose customers.
You would think so, but not this time. Management described the reaction as like a tree falling in the forest, a total non-issue.
Which means nobody cared.
Nobody blinked. And that tells us something very important about the product. Demand is inelastic.
It's mission critical.
Exactly. If you are a hospital or a logistics company like FedEx, you cannot function without the network. You aren't going to cancel your order because the price went up 7%. You just pay it.
However, even with the price hike, There was a little bit of an amber flag on the dashboard regarding margins.
Right. The gross margin.
It came in at 62.0%, which is down 140 basis points year over year. And the guidance for Q3 suggests margins might dip even further, down to the 61% range. So if they are raising prices, why are margins going down?
This is where you have to look past the headline number. This is actually a good problem.
How is shrinking margin a good problem?
Because of the mix of revenue. Remember those stadium and large venue wins we talked about?
Yeah.
When you win a deal that big, the customer often says, hey, we don't just want the hardware, we want you to install it for us. That's professional services.
Okay, so they are charging for the installation.
Correct. But installation is super low margin, maybe 15 to 20%, because you're paying humans to run cables and configure racks.
I see.
So compare that to the software subscription, which has 80% margins. Because they have this huge glut of massive installation projects happening in Q3 and Q4, the low margin service revenue is diluting the average.
So they are taking a hit on the margin percentage now to secure the customer for the long term.
Exactly. You do the hard work of installation at a 15% margin so you can secure that 80% margin recurring revenue for the next 5 to 10 years. It drags the average down temporarily, but it secures the annuity.
That makes sense. It's like buying the printer cheap so you can sell the ink forever, except here you're doing the installation cheap to sell the saws forever.
Precisely. And the market seemed to understand that nuance given the stock reaction. It is strategic dilution.
Now, we can't ignore the elephant in the room, or maybe the elephant that might be entering the room, the rumor mill.
The Ruckus rumor.
Yes, there was chatter about Extreme potentially acquiring Ruckus Networks from CommScope.
This came up in the Q&A. CommScope is carrying a heavy debt load and might be looking to sell assets. So an analyst asked directly about it.
And the CEO, Ed Meyercord, gave the most classic non-denial denial I think I have ever heard. He said, if assets are available, we're always going to have a look.
Which translates to, we are definitely looking, but I can't tell you that.
Right. So what's the strategy there? Does Extreme even need Ruckus?
It's about scale. Ruckus is huge in Wi-Fi, especially in like hospitality and education. If Extreme buys them, they instantly grab a massive chunk of market share and broaden their footprint.
But management said they only look for deals that are accretive.
Meaning it has to add to earnings immediately. But is there a downside?
I would think so.
Absolutely. Acquisitions are messy, integration takes a long time, and we just spent 10 minutes praising Extreme for being agile and scrappy. If they swallow a big entity like Ruckus, do they lose that agility? That's the question investors need to weigh.
That is the danger of eating too much lunch. You might get a stomachache. Let's zoom out to the investor context. Why does all this matter right now?
Yeah. What are the macro trends?
We mentioned the David versus Goliath thing, but what's helping them?
Two big ones. First, data sovereignty, especially in Europe.
Okay, break that down. Why does a German bank care about Extreme versus Cisco?
Well, European regulators are becoming incredibly strict about where user data lives. They do not want European user data sitting on American servers subject to the U.S. Cloud Act. And Extreme claims to be the only vendor offering true cloud choice.
Meaning
You can run Extreme's management software on AWS, on Azure, or, and this is the key, on your own private servers in your own basement. Most competitors force you into their public cloud.
So Extreme lets you keep the data entirely within your own borders.
Exactly. So if I'm a German bank, I can run Extreme's AI on my own servers in Frankfurt and not worry about U.S. privacy laws. The competitors often lock you in. So this is a huge regulatory moat in the EMEA region.
Okay, and the second trend?
The upgrade cycle. Cisco has a massive install base that is reaching end of life. Those boxes have to be replaced. And at the same time, Cisco changed their partner program, which annoyed a lot of resellers.
So the gate is open.
The gate is wide open. Extreme estimates there are billions in total addressable market up for grabs right now. They are hunting in Cisco's backyard.
It really feels like the stars are aligning for them. You have the tech refresh, you have competitor confusion with HPE-Juniper, and you have the regulatory environment all favoring their architecture.
And the stock momentum reflects that. Leading into this call, EXTR was already up 23.3% over the last 90 days. It's outperforming the tech sector ETF and the S&P 500.
So the train was already moving, and this earnings call just added more coal to the engine.
And it validated the narrative shift. For years, Extreme was just a hardware box shifter. Now, with ARR growing 25%, they are successfully convincing the street they are a SaaS story.
And that usually leads to multiple expansion.
It means investors are willing to pay more for every dollar of earnings.
Okay, let's unpack this. We have a clean beat, a supply chain that could survive a zombie apocalypse, and a competitor landscape that is practically handing them market share. But what does this all mean for our listeners who like to take a little risk?
I think I know where you're going with this.
It is time for our favorite segment.
Disclaimer time.
This is not financial advice. We are two voices on a podcast, not your financial fiduciaries. Do your own diligence. Do not trade based on our banter. This is for entertainment only. Now pitch me.
All right, I have a trade idea for you based on that AI discussion. I call this the lazy sysadmin long.
The lazy sysadmin long. I love it already.
Here is the thesis. Extremes Management says their agentic AI turns 6 hours of troubleshooting into 6 minutes. They claim it acts like an extra engineer.
Right.
So if I am a CIO and the AI is fixing my network autonomously, who do I stop hiring?
The expensive external consultants who charge by the hour to come in, plug in a console cable, and type commands all day?
Exactly. So the trade is long extreme networks, EXTR, and short IT staffing and consulting firms.
Yeah. Oh, that is ruthless. I love it.
You bet on the robot that fixes the Wi-Fi, and
Yeah.
you bet against the guy charging billable hours to troubleshoot the Wi-Fi. If the AI works as advertised, the demand for that low-level network troubleshooting labor just evaporates.
That is actually frighteningly plausible. It's a hedging strategy against human inefficiency. I have one too.
Let's hear it.
I call this the sovereign cloud spread. You go long extreme because they are the only ones compliant with those strict EU data laws. And you short the US-centric cloud-locked vendors who are about to get slapped with massive fines by European regulators.
So that's a regulatory arbitrage play. You're betting that the EU gets tougher on data residency, which, let's be honest, they always do.
They always do.
Which forces money toward the only vendor who can actually handle it. I like it. It's the keep the data in Germany trade.
Exactly.
Both of those play directly into the why behind their wins this quarter. It's not just about faster chips. It's about aligning with where the labor market and the regulatory market are going.
So bringing it all back home, we saw a beat and a raise, we saw the SaaS transition actually working, and we have a stock that is responding to a profit faster than revenue story.
It's a solid quarter. No drama, just execution. They are navigating a tough environment better than the giants they are competing against.
But I want to leave you with one final thought to mull over. We talked about that ruckus rumor. If Extreme buys ruckus, they get bigger, they get more scale. But right now, their superpower is that they are small, fast, and scrappy-like, finding those chips in a scrapyard. If they buy ruckus, do they become the very thing they are currently defeating? Do they become a Goliath?
That is the risk. Sometimes winning means knowing when not to grow too fast.
Something to think about while you're waiting for your Wi-Fi to connect. Thanks for diving deep with us on Talk Tickers. See you on the next ticker.